A life insurance policy may involve a single premium payable at the outset of the contract, or a regular series of premiums payable provided the policyholder survives, perhaps with a fixed end date. In traditional contracts, the regular premium is generally a level amount throughout the term of the contract. In more modern contracts, the premium might be variable at the policyholder's discretion for investment products such as equity-linked insurance, or at the insurer's discretion for certain types of term insurance. Regular premiums may be paid annually, semi-annually, quarterly, monthly, or weekly. Monthly premiums are common as it is convenient for policyholders to have their ongoings payable with approximately the same frequency as their income. So an important feature, and you can see that we start at 0 and the 10th premium paid will end at 9. The same goes to monthly payments, which start at 0 and the last one will end at 9.1112 years. So we assume that all months are equal in length and each month is 1/12 of the year. Annuity contracts offer a regular series of payments. When an annuity depends on the survival of the recipient, it is called a life annuity. The recipient is called an annuitant. If the annuity continues until the death of the annuitant, it is called a whole life annuity. If the annuity is paid for some maximum period, provided the annuitant survives that period, it is called a term life annuity. Annuities are often purchased by older lives to provide income in retirement. Buying a whole life annuity guarantees that the income will not run out before the annuitant dies. We can specify several types of annuity. So first one is single premium deferred annuity, SPDA. Under an SPDA contract, the policyholder pays a single premium in return for an annuity which commences payment at some future specified date. The annuity is life contingent, by which we mean the annuity is paid only if the policyholder survives to the payment dates. If the policyholder dies before the annuity commences, there may be a death benefit due. If the policyholder dies soon after the annuity commences, there may be some minimum payment period, called the guarantee period, and the balance would be paid to the policyholder's estate. Next one, SPIA. The contract is the same as SPDA, except that the annuity commences as soon as the contract is effected. This might, for example, be used to convert a lump sum retirement benefit into a life annuity to supplement a pension. As with the SPDA, there may be a guarantee period applying in the event of the early death of the annuitant. Next one, RPDA. It offers a deferred life annuity with premiums paid through the deferred period. It is otherwise the same as the SPDA. Joint life annuity. This one is issued on 2 lives, typically a married couple. The annuity, which may be a single premium or regular premium, immediate or deferred, so this annuity continues while both lives survive and ceases on the first death of the couple. Last survivor annuity. A last survivor annuity is similar to the joint life annuity, except that payment continues while at least one of the lives survives and ceases on the second death of the couple. Reversionary annuity, the last one, is contingent on 2 lives, usually a couple. One is designated as the annuitant and one the insured. No annuity benefit is paid while the insured life survives. On the death of the insured life, if the annuitant is still alive, the annuitant receives an annuity for the remainder of his or her life. Other insurance contracts. The insurance and annuity contracts described above are all contingent on death or survival. There are other life contingent risks, in particular involving short-term or long-term disability. These are known as morbidity risks. First one, income protection insurance. When a person becomes sick and cannot work, their income will eventually be affected. So for someone in regular employment, the employer may cover salary for a period, but if the sickness contains, the salary will be decreased and ultimately will stop being paid at all. For someone who is self-employed, the effects of sickness on income will be immediate. Income protection policies replace at least some income during periods of sickness, and they usually cease at retirement age. The second one, critical illness insurance. Some serious illnesses can cause significant expense at the onset of the illness. The patient may have to leave employment or alter their home or incur severe medical expenses, so critical illness insurance pays a benefit on diagnosis of one of a number of severe conditions, such as certain cancers or heart disease. The benefit is usually in the form of a lump sum. And the last one, the long-term care insurance. This is purchased to cover the cost of care in the old age when the insured life is unable to continue living independently. Next one, pension benefits. Many actuaries work in the area of pension plan design, valuation, risk management. The pension plan is usually sponsored by the employer. Pension plans typically offer employees, also called pension plan members, either lump sums or annuity benefits, or both on retirement, or deferred lump sum or annuity benefits, or both on earlier withdrawal. Some offer lump sum benefit if the employee dies while still employed. The benefits therefore depend on the survival and employment status of the member and are quite similar in nature to life insurance benefits. That is, they involve investment of contributions long into the future to pay for future life contingent benefits. So we can see the defined benefit and defined contribution pensions. So the first one is funded by contributions paid by the employer and usually the employee over the working lifetime of the employee. The contributions are invested and the accumulated contributions must be enough on average to pay the pensions when they become due. The second one, defined contributions pensions, work more like a bank account. In the United Kingdom, most of the proceeds must be converted to an annuity. In the United States or Canada, there are more options. The pensioner may draw funds to live on without necessarily purchasing an annuity from an insurance company. You can also get acquainted with defined pension design. So many employees leave their jobs before they retire, and a typical withdrawing benefit would be a pension based on the same formula as the age retirement pension, which defines the pension payable from retirement in a standard final salary plan. Employees may have the option of taking a lump sum with the same value as the deferred pension, which can be invested in the pension plan of the new employee. Some pension plans also offer death in service benefits for employees who die during their period of employment. Such benefits might include a lump sum, often based on salary and sometimes service, as well as the pension for the employee's spouse.